Okay. We got one more person came in. Okay. I want to introduce to everybody Rob Beardsley. Rob is going to introduce himself, but Rob wrote a book. What was the name of your book, Rob? It's
The
on
definitive,
the
the definitive
definitive guide to.
underwriting multifamily acquisitions.
Okay. So Rob is, it's an honor to have Rob with us, and he is coming to us directly from Croatia. So we do appreciate that he got up in the middle of the night to go ahead and do this presentation. And we absolutely do appreciate it. So we've got a nice group here tonight. So, Rob, why don't you tell us a little about yourself and what you're doing, and then we'll let you go ahead with your presentation.
Okay, great. Yeah, so hey everybody, thanks for being on here tonight. Pleasure being here. My name is Rob Beardsley. I'm the co-founder of Lone Star Capital. We are a multifamily owner operator focused on uh, Texas multifamily, primarily workforce housing. You know, the bread and butter workforce value add that everybody loves so much. We have a primary particular focus on Houston. We have now over 1,200 units throughout Texas, and are actually most excitingly for us, we are in the process of finally launching our in-house management company and are bringing all of our operations across the portfolio in-house in about a month. So that's a little bit about us. And as Jeff mentioned, last year, shortly into the pandemic, I self-published my book on underwriting, which is available on Amazon. And that has been in a way, life-changing experience. It's been very cool to see, uh, all the people that I've met as a result of the book and all the people that reach out and say, hey, this has helped me so much and that kind of stuff. So it's been a very fulfilling experience. And I didn't really have much expectations when I wrote the book. I just felt that it needed to be written. I felt compelled because when I started in multifamily, to me, it felt obvious that underwriting was such a critical component of the business, and it is. And yet there was no definitive guide or any real consolidated resource to, learn the craft and kind of hear from others how they were approaching it. Because while it is numbers, it is an art just as much as it is a science. So that's really where I'm coming from with that. And tonight, I won't be walking through the my whole underwriting process or anything like that. We'll be focusing on 5 key components that I feel are most relevant in today's market. As you all know, today is a very competitive time to be buying deals, and so that makes your job as an underwriter that much more difficult. So I wanted to pick out 5 areas of particular importance and share those with you today. And Jeff kind of put me on the spot here because he's anticipating my sharing my screen. I do not have a fancy presentation, so I do have my spreadsheet at the ready. So as we get into the presentation, if we, get to a point where it makes sense to share my screen and actually plug in some numbers, I'm more than happy to do that. I would love for this to be interactive, so please, feel free to chime in at those moments. Um, but otherwise, I'll be just keeping things just general and high level and sharing these 5 points, which actually I think Mike posted in the LinkedIn group ahead of time. So that's pretty cool. So I did rearrange the top 5, and we're going in the order of operations to essentially, operations, debt, growth, exit, right? So we're going in a logical way that way. Also, in my opinion, we're kind of going from boring to more interesting. So starting with number 1, we've got property taxes. Now, on property taxes, it's different, obviously, from where you are, state to state, even county to county. So I don't want to speak for everywhere across the country and for everyone doing deals, but I'll kind of share our Texas experience and then map that to the two important aspects of property taxes. So most of you probably are familiar with the fact that property taxes can be fairly volatile upon a sale, right? So there's some states are disclosure states where you have to disclose your sales price to the county, and then that has a direct implication to your future property tax assessment, and what you'll be paying once you take over. So there might be a big step. The seller might be paying 100,000 in property taxes per year, and then upon your takeover of the property, your taxes might jump to 200,000. So, I think many people are aware of this now and are looking for that. So, and you should be, and it's very important. You have to discount completely whatever the seller's paying, because that might be completely irrelevant to what you'll be paying. So, and the way that we underwrite, just kind of as a side there, is, when we're looking at cap rates and valuating a property, we substitute the seller's taxes for what we believe the future taxes will be to actually derive a in-place cap rate. So we know realistically on an adjusted basis how much potential income are we buying here. Obviously discounting whatever the seller's expenses are, because those aren't our expenses. So that's just an aside. But so that's number one, right? We've got that step from from the sale in property taxes. And like I said, a lot of people are aware of this and are acting appropriately. But the next step, which is, maybe just as complicated or just something that you need to be factoring in, is the growth factor of property taxes. So, and again, this varies, in California, you've got 2% per year and it's just standard. You don't have to worry about it. In Arizona, it's up to 5%. So you've got that ceiling, which is nice. And then in the Wild West in Texas, there is no ceiling, and things can be volatile even after you close in your year-over-year property tax reassessments. So speaking of our experience personally in Texas, and the guidance from our property tax consultants, the way that we approach our annual property tax growth is we try to do our best to mirror our revenue increases mirror the property taxes with our revenue increases. And so because Texas, generally speaking, is an income-driven appraiser, meaning they're not really much looking at sales comps, and they're focused on the income to derive their assessed value for the property taxes. So with that in mind, if you buy a property and you double rents or you double income because of your value add business plan, you need to similarly anticipate a increase in property taxes, maybe not to the same degree, but that trend has to follow suit. So that's what we do. If we're buying a property and we're keeping operations and income relatively flat, then property taxes only need to grow around 2-3%. But if we have an aggressive value add and we plan on raising rent substantially, that's where we need to, the growth rate for us could be anywhere from 5%, 10%, 15%, just depending on how we're modeling it out, and also how many years are we underwriting for. If it's a 3-year hold, which we do for bridge loans, then you may want to be more aggressive on your property tax increases. Also, assuming if you're doing a bridge loan, you're probably doing a heavy value add, so it just makes sense to have more tax growth as well. So, but if you're doing a 10-year hold, it would be pretty penalizing to have a 10% growth rate in your property taxes year over year over year for 10 years. So you just want to be cognizant of hold period in relation to that as well. So like I said, starting with the boring first, I felt that this was a really important, one of the top 5 certainly in terms of underwriting, because so many times people are looking at a deal and it's really make or break. It could be a great deal when you underwrite property taxes at 70% of purchase price, but then if you bring them up to 90% or 85%, it completely changes the deal. So something to certainly keep in mind. And coming back to Texas for us, taxes can make up 20%, 25% of your operating expenses. So it certainly is a material one that you don't want to get wrong. We try our best to stay on the conservative side on property taxes, and and make up for it by being aggressive elsewhere if need be. Just because property taxes is something less that you can control, so it's better to just assume, for us, there's a big range in Texas, but 85% of purchase price is kind of our general rule of thumb. And then again, we're growing basically somewhere around our revenue increases. So if revenue on average over 5 years is increasing by 5%, then we might have property taxes increase by 5%. Okay. Like I said, please feel free to just chime in the chat, or I don't know if we're allowing people to unmute themselves and just have a conversation, but more than happy to stop anytime to answer any questions, or if there's a corollary, we can dive into that as well. But if
Rob,
not,
if we could, let's just have people just either put it in the chat or hold the questions to the end. It might be the easiest way to do it.
perfect.
All right.
Okay,
Thank you.
awesome. So diving into number 2, another relatively boring topic compared to the exciting future topics of debt, growth, and exit strategy, we have insurance. So insurance is insurance. I'm not an insurance broker nor an expert, so it's just critical to have to have a good relationship with your insurance broker. Things are tough out there for insurance, at least in Texas. There's there has been big loss events in the last few years, which are driving some insurance companies to go out of business, and others obviously to raise their prices to combat those losses. And something we're also seeing is the less willingness for some of the brokers that we work with to really provide us meaningful quotes until we actually have the property secured. So, that may or may not be the case in the market you're in, but that's something that we're experiencing right now. It might be due to, I don't know, change in pricing. It might be due to volume. So that's making us be, in lieu of having a quote that we can really rely on, we're being extra conservative on insurance. And in particular in Houston, for us, there are certain locations, certainly not all of Houston is a flood risk, but there are, as substantial portions of Houston which are that have some component of flood risk, maybe not completely or completely. And we try to be as smart as possible with this. So, to kind of get more advanced, you can get elevation certificates, you can hire a consulting company to try to reevaluate the elevation certificates. So they aren't what they are. They can be updated, and you can get part of the property carved out of the flood policy or different things like that, to try to get as cheap of insurance as possible. However, getting the cheapest insurance is not always the best insurance. We just recently closed on a property which was not in a flood zone, but it is in Clear Lake, which is right there near the water. And the property did flood during Harvey in 2017, and so we purchased flood insurance, even though it wasn't in a floodplain and it wasn't required by the lender. So you just kind of have to evaluate what makes sense and if it fits in the budget, and act accordingly. So so I think that's just a quick one. Insurance, not much I can share about it, but I do believe it is a one of the top 5 certainly to get right. You can spend all your time on trying to perfect your payroll budget, your rent comps, which are very important. I'll say rent comps are more important than insurance, but insurance is definitely in the top 5, at least today, and in our market. If you're paying $100 a door for insurance, then I get it. It's not a big deal if it's 100 versus 120. But when you're talking about insurance being 600 a door, 800 a door, 1,000 a unit, that's when it can be pretty wild. So yeah, and Leon sent me a message about premiums going up year over year. Same thing as property taxes. Insurance is very well, unlike property tax, insurance is cyclical, and in the last few years, rates have really gone up um, quite a bit, and there's there's not much you can do about it except prepare and adjust your expense growth factors accordingly. So finally, we're moving on to something more exciting, which is debt. So irrespective of the market, whether up market, down market, or where you are in the country, valuation underwriting is heavily correlated to debt. If you don't maximize or choose the right debt option, it can lead to undue risk, or it can just lead to your offer not being competitive enough to actually win the property. So, as we all know, that 99% of real estate is leveraged with debt. So real estate is a levered asset class, and what we're all looking for is levered returns. We aren't all satisfied with just unlevered returns, or we don't base our decisions, generally speaking, on the unlevered return potential of a property. We're looking at the levered results because, for example, today you might be able to acquire a property that's subject to a loan assumption. You have to assume the property's existing debt, which can be a great strategy because if the debt is unattractive, you might be able to actually get into the deal at a discounted basis, but hopefully that discount is more than enough to offset the negatives associated with the debt that you're assuming. But see, if we didn't even look at the debt, right, we would say, oh, we're getting this deal at a discount, and this is a great unlevered deal. But then once you add in the leverage, it's not a competitive deal compared to what you could get on the market free and clear. So with that being said, there's, I guess, for the most part, three different debt strategies out there today. I'd say maybe four if we include the loan assumption. So since I mentioned loan assumption first, that is a strategy today. You can assume someone's existing debt. And kind of like I hinted at, if it is unattractive, they might have acquired the property a few years ago with a fixed rate, back when fixed rates were maybe near 5%. That's certainly higher than today's prevailing rates. And so you should absolutely receive a discount for that asset. And, as they say, financing is temporary, price is permanent. So theoretically, it's still a math equation. If you're getting debt that costs you an extra, maybe $1 million over a 5-year hold, you need to at least get a $1 million discount on the property. And if you're using a net present value or an IRR, right, you need even more because it time value of money. So and then even when you are presented a loan assumption opportunity, you still have the option to understand what the seller's prepayment penalty is, and then you can essentially make a decision for yourself. Because if you're willing to pay the seller's prepayment penalty and put on new debt yourself, it's really no difference to the seller. The seller will net the same amount, right? So if they have a purchase price of 10 million subject to assumption, and they have $1 million prepayment penalty, if you offer $11 million free and clear, it's the same thing to the seller. So that's up to you and your analysis to determine which one is more favorable to you. Something that's really interesting about this is oftentimes what you see on a loan assumption opportunity is the rate might be a bit higher, but the real kicker is the debt might be amortizing, and it may have already been amortizing for a few years. And that's going to lead to below average cash flows for your property. So often when you underwrite a loan assumption of this nature, you're going to see two things. Well, hopefully one thing you're seeing is if it's priced appropriately, you're seeing an above average IRR, which makes up for the below average cash flows due to the higher rate and amortization. So that's a really interesting deal strategy, in my opinion, because you're essentially trading yield for total return, which, in the words of Warren Buffett and Charlie Munger, they would much rather prefer a lumpy 15% return than a smooth 12% return. So, and I generally agree with that notion. Unfortunately, most investors do not agree with that, right? Investors love monthly cash flow and they love it to be strong. And there's good reason for it, more than just mailbox money. There is a risk mitigating factor associated with monthly cash flow, right? If a property is cash flowing at a healthy rate, that's an indication that you bought the property at a good price and it's performing well. So if you can look past the higher interest rate and the amortization to kind of see through to the asset and understand its cash flow performance, you maybe can get over that hurdle that it may be only cash flowing at 4%. But if it were to have interest only, for example, then maybe it's 8% or 9%, and the same result that would occur if it were healthy cash flow in the free and clear scenario. So that's an interesting strategy. And if you can truly get a premium in your total return, right, the lumpy 15 versus the smooth 12, that is, I think that's a fabulous business plan. And what is the premium that I think is appropriate, right? If you're only getting a 1% increase in your IRR, it's probably not worth it to suffer through those worse cash flows. Now, don't forget, IRR is taking into account the fact that you're not getting as much cash flow, because IRR is a compounding function that does take into account the time value of money. So you're going to achieve a higher total return or annualized return or equity multiple with the same IRR, assuming you have worse cash flows. It's just that you're going to get more of that money towards the end. So, but what I would say is from our experience and the way that we're pricing things, if the cash flow really is subpar, then, due to the assumption, then we're going to seek somewhere around 3% premium in IRR, which means if we felt that a 14 is appropriate for this asset and business plan and market and risk, then 17 is what we're going to demand. That's a little, in my opinion, rich, but I think that's just where we have to be in order to, not go crazy raising capital. Because if I just know that my investors, generally speaking, are, going to have a harder time with, a 15% return with lower cash flow. So I need to have a premium there. And, that may or may not lead to us being as competitive as we'd like on these loan assumption opportunities, but it is what it is. So let's see here. So in terms of a healthy rate of cash flow, that's a great question. It depends on the location, but it's somewhere between, I'd say, 7 to 9% average. And that average is heavily skewed by your interest only period. You might have 1 year of interest only, or you might have 5 years of interest only, which will substantially affect the 5-year pro forma, for example. So it's a big difference. But assuming you're taking on the best available debt out there today from Fannie and Freddie, which is pretty attractive stuff right now, I would say 7 to 9% average over 5 years. Okay, so the next debt strategy is, really free and clear, right? You're able to put whatever debt you'd like on it on this new acquisition. And your two big buckets today are agency debt and bridge debt. So for those that are less familiar, agency debt is Fannie and Freddie provided mortgages, and they are typically the cheapest, best options out there. Today they're coming in around 65 to 75% LTV, and that's based on where cap rates are and the debt service coverage ratio. And interest only is pretty attractive as well. We're seeing, we just closed the property last week, and it was 4 years of interest only on a 10-year loan. So, that's very favorable. So I would say the highlight of agency debt is the most popular term for agency is 10 years, and it's a permanent loan. And so the rate is low. So those are the two highlights in my opinion. Low rate, 10-year term. The 10-year term is probably the most important part, because with such a long term, you are eliminating a lot of um, maturity risk. So if you have a maturity 10 years out, and assuming you're going to amortize at least, I don't know, 5-6 years prior to that maturity, your LTV at that point in time is likely to be very low in relation to your value at that time, assuming markets progress and you have appreciation. So refining into a new loan should be academic. There should be a substantial gap, and you should be able to actually cash out and return a lot of equity to the partnership. So kind of looking 10 years out, that's a very low risk situation of being in a situation where, your loan is 10 million and it's coming due, and, the property is only worth 11 million, and you can't really get a loan to pay off your existing loan, and you're kind of in a hung scenario. So the shorter your maturity, the sooner it is, the more that risk comes into play, because it's less time for the market to appreciate, it's less time to potentially amortize, and that leads to greater risk. So that's, in my opinion, the best part about agency debt is that 10-year term, because it is substantially lower risk than if you had debt that was 2 to 3 years in term. So with that in mind, and while we're underwriting, it's not just about plugging in debt and going about your business. It's correlating the debt and everything, and how it relates to risk, and then pricing that risk appropriately. So for me, as a sponsor or as a passive investor, which I am myself, of course, if I'm looking at a deal that has agency debt versus bridge, which we'll get into in a second, I'm looking at it much more favorably. And, to quantify that, I'm probably looking at a 2% premium for the bridge loan in order for me to be enticed to want to do that. May even be 3%. It just depends on the business plan and the risk and the terms of the debt. So just as an example, in a really hot market like Phoenix, for example, or Tampa, where there's just a whole ton of upside, ton of growth, nothing is seemingly stopping those markets, I would be willing to invest for a 12% net IRR, assuming it's agency debt. Now, if it's a bridge loan, I probably need it to be up to more like 15%. And now, switching over to the bridge loan, I'll explain more about why. So as I mentioned before, the term is a big reason why. Bridge loans are shorter term loans, they're transitional loans, and they typically are about 3 years in term. And so not only is it more risk because you have 3 years before you actually have to pay that loan off, the other reasons why it's riskier is because a bridge loan is typically higher leverage than an agency loan. So, and it's higher leverage nominally because it's typically 75, 80% loan to cost. So you're getting a loan based on your total cost of purchase price and your Capex. So it's a just a bigger metric there, and it can be higher, 80% versus 70, 75. And the big difference is on an agency loan, you're being lent money subject to or based on the existing income that exists today. There's, you can show an agency lender your business plan. I'm going to raise rents. I'm going to, add a fitness center. I'm going to do all these things. And they're going to say, that's all wonderful, but we're going to give you a loan just based on the income that the property exhibits today. Now, a bridge lender is substantially different. A bridge lender is lending you money based on a pro forma, and therein lies the greater risk, because the lender and yourself are making a bet on the future, which is fine, and that's what you should be doing as an equity investor, right? You're planning for the future. You're solving for an upside, But when your lender takes that risk, right, that allows them to provide greater leverage, more leverage than what often can be justified based on the in-place income. And so now you've got two things. It's a race against time. You've got the 3-year maturity, and then you've got the need to actually implement your business plan successfully in order to be able to support that in-place debt. And when I mean support, I mean, less about cash flow, because you can set up interest reserves and things like that. But what I mean is you need to actually create enough value on the by the 3-year timeline to be able to refi and pay off that bridge loan that originally came in at higher than what would be able to be placed in an agency debt scenario. So that sounded pretty extreme. So hopefully you don't think I hate bridge loans. I'm actually a big fan of bridge loans. We've refinanced out of 3 bridge loans to date. And so we really like the strategy of being able to come in aggressively and with the flexibility of the bridge loan to implement our business plan, and then have the optionality to sell or refi and pay minimal penalties. So, but we're just very cognizant of the added risks, the added cost, and we try to price those appropriately into our model. So to comment on what's happening today, it's a very interesting time, and as we all know, cap rates are low. I wouldn't say they're unreasonably low. They're just low because debt is cheap and the world is competitive. But what's really interesting today is we're seeing a lot. So bridge lenders have gotten much more competitive. The universe of bridge lenders has expanded substantially. And now, because of that added competition, bridge lenders are lending money very cheaply. And that's resulting in the spread, the cost spread between permanent debt or agency debt versus bridge, very narrow. And the added leverage you're getting from bridge is, very attractive. So if you're getting added leverage for a minimal cost increase, it is a compelling proposition for many. And so what we're seeing today is many groups are opting for bridge loans, really irrespective of the business plan. It's not like they have a transitional business plan necessarily. They are often buying stabilized properties, but they're opting for the bridge loan simply for the leverage and for what that does to their prospective returns, which obviously leverage magnifies your potential return. But in my opinion, this is kind of the worst situation, because you don't really have a business plan that supports the exit of the bridge loan, and so you're taking on that risk that isn't supported or justified. And then what that is causing is it's allowing prices to be bid up, because if you're underwriting with a bridge loan, it's allowing you to be able to solve for a higher return or raise your price and come to the same return. And your pricing, if you're competing against a buyer that's using a bridge loan and you're buying the property subject to an agency loan, that you typically will not be the most competitive in terms of levered IRRs. So you are likely to be bid out. And then then you're going to get frustrated. Now you're going to go and try to buy the deal with a bridge loan, and then we're all using bridge loans, and then we're all adding, systemic risk, in my opinion, to the market. So that is something that I think is very topical for today. Again, I don't hate bridge loans. I actually love bridge loans. But there's just not many opportunities out there today that are attractive enough that you'd want to do it with a bridge loan. Like I said, you need that added return premium, and you really need a business plan to justify the exit. If you want to learn more about whatever justifying the exit means, you can look for an article of mine about the refinance exit test. And there's actually a test that all lenders do, and you should be doing it as well if you're doing a bridge loan, to actually test the exit and to see. And it's very simple. It's basically you just look at what the in-place bridge loan will look like upon maturity, which it would likely look the same because bridge loans typically don't amortize. And then you look at what projected value you think you will have in at maturity in 3 years. And then you make some predictions about where you think the capital markets will be in terms of loan to value, interest rate, um, and then you compare. So based on your future value, create a hypothetical loan amount, and then you compare that to the to the existing debt, and it should be greater, and that means you pass the test. If it's less, then you would have a tough situation where you would actually have to have a capital call in order to keep the deal afloat in that refi scenario. So, and Jeff is asking about bridge loans with Capex, a holdback. And so, yeah, so most bridge loans, they, when they add that added leverage and they're lending based on your Capex costs, so your construction budget, they don't just fund it all up front. They hold it back, and as you complete work, they'll disperse funds. So I think that's a wonderful tool, because if you're the alternative, if you're forced to raise all your Capex out of equity and you have a substantial budget of, let's say, 10 to 20,000 per unit, that is a ton of equity, and it's also debt equity that's just going to have to sit in your account for quite some time, assuming you're not going to be able to finish your project right away. So what's really nice is, a bridge loan structured well will not charge you interest on unfunded Capex or unfunded portions of the loan. So that's nice, right? You don't have that dead capital scenario. So as you complete work, the money gets funded, and now you begin paying interest on those dollars. So it's a very efficient way to go. And you don't have to carry construction float as much, depending on how fast the bridge lender is in dispersing funds. Because if the bridge lender takes months and months to approve your draw request, you're going to have to pay your vendors, and you might have to come out of pocket, $100,000, $200,000 before you finally get reimbursed by the lender. So you need to have that extra equity on hand to be able to manage that, manage that float, essentially, that the time between getting actually the draws. So definitely, if, depending on your business plan and your needs as far as the Capex line of credit, ask your bridge lender how fast they typically turn around their draws, and, determine what is appropriate for you. Going back to a question real quick to just address about what do I prefer personally as far as interest only or amortized debt? I prefer interest only all day long. The way that debt gets underwritten is, on the agency side at least, it's sized to the in-place income. So the going in leverage is at the leverage point that I'm comfortable with and that I am looking for. So I don't want to amortize and pay down that debt. That debt is highly attractive to me at 3% today around. And essentially, when I amortize, I'm paying down that debt. And in a way, you can think about, I'm earning a 3% return on the money that is used to pay amortization. So while reducing your risk through amortization is great, I don't want to earn a 3% return, and my investors don't either. So interest only it's a fabulous thing. And we try our best to amortize as little as possible. So what that means, opting for as long of interest only periods as possible, and then refinancing when the interest only period is expiring. So speaking of which, going back to the 10-year, we're going back to the agency side and the 10-year side of things. I just want to, slip in this quick point before we move on, which is the discussion between floating rate and fixed rate debt. People have their strong emotions or strong convictions about one or the other. And, some arguments are emotional, some arguments are mathematical, both are valid. And the big point I want to just really mention, rather than trying to talk about a floating versus fixed discussion, is really just mention the the realities of fixed rate debt and the prepayment penalties that come with fixed rates, right? So typically you have yield maintenance or defeasance, which is a very expensive prepayment penalty that precludes you often from prepaying the loan until the latter years of the debt term. So I've never seen someone underwrite a deal and actually factor in a yield maintenance prepayment penalty. Um, it's it's a hugely important aspect of the deal. And sure, you may just say, well, I'm going to let the next buyer assume the debt, and that's perfectly fine. And in that case, you wouldn't pay any penalty. But if you're going to do that, then you have to assume some sort of hit to your purchase price or your sale price at that point, associated with forcing a buyer to assume your existing debt. So that's something that is off. I've never seen it included in underwriting, so it's always left out. And it's really a hard. There's not a good way to go about it. If you're going to underwrite it, one way to do it is if you're going to get a 10-year fixed rate loan, you can underwrite a 10-year hold, and you don't have a prepayment penalty. You can just pay it off at par at that point. But not a lot of investors like to see you underwrite a 10-year hold because they don't want to be in the deal for 10 years. So then you have to underwrite maybe a 5-year hold. But then you've got you're right in the middle of a nasty prepayment penalty. So it's a tough one, and would love to hear from you guys maybe in the Q&A after how you would approach this. We haven't done a fixed rate execution in a while, but the way that we have been looking at them is actually doing a 7-year hold and a 7-year loan term. And so we match the term of the underwriting to the debt, which is, very logical. And then that way we avoid having to model in a prepayment penalty. So like I said, we haven't done a fixed rate execution in a while, but that would be, at least that's the way we think we would approach it and the way we've been looking at it. So we're getting close to time here, and we've got, we've saved some of the best for last. I don't think it would be as complicated as the debt piece, but number 4, we're going to growth. Now, growth, I'm really mostly talking about rent growth. And so, a lot of people are saying that now we're in the roaring 20s, and it sure seems like it with a lot of things that are happening. And if you have looked at a CoStar report lately, depending on the location, there is some substantial rent growth happening and projected to continue to happen over the next couple of years. And what's really interesting about that is I was actually talking to an investor about this yesterday. If rent growth is going to be somewhere between 2 and 3%, that's going to be priced accurately. Everyone in their model is going to be using 2, 2.5, 3, and so people that are underwriting 3%, they might get disappointed when rent growth is only 2. And if you're underwriting 2, you might get a little bonus. So it's not a big, it is still a big deal when you're talking about 2 to 3%. But you're not going to be off by too much, right? The market's going to be pretty efficient and accurate. Now, what's crazy is we were looking at a deal in Tampa, and that submarket is projected to have 15.4% rent growth in the next year, right? It's just absurd. And I guarantee you, the market is not going to do as accurate of a job pricing that into the model as you would in another situation. So we're in a situation, I think, when you're at these extremes, right, it's much more difficult to underwrite. And I think it presents opportunity. And I think, I think now it's a question of, okay, do we how do we include this 15% rent increase into our underwriting? Should we use 15% rent growth? Right? Obviously that'd make your deal look incredible. But, and so the right answer is no, in my opinion. But so how do we actually factor this in? How do we fully appreciate the benefits of this that may be coming, or that is already happening in many of these growth markets that have been accelerated coming out of the pandemic? And in my opinion, there's really 2 ways to do that. And those are, 1, lower your return hurdle, right? So if you're normally looking for a 14% IRR, well, if you're shopping for a deal in a market where there's, just fantastic rent growth projected, you might be willing to actually go down to a 12% return hurdle, knowing that you're likely going to have upside over and above your hurdle, just because you're not fully factoring in the rent growth. The other way to go is to, use I'm seeing a lot of people use a 5-4-3-2, 5-4-3-3 kind of schedule on their rents. So they'll use 5% rent growth in year one, then 4, and then they'll stabilize at 3. So they're kind of trying to get a little more juice, and people were doing that uh, pre-COVID as well. But that is, that's one way to go. Or you can actually kind of bake in some of the anticipated rent increases in the short term into your pro forma rents. So you might be doing a value add where, you can justifiably increase rents by $100, but you might do, $120 to factor in that future growth that, may or may not be projected in your scenario in the next year or two. So that's a quick one about growth. Growth is today and has always been a super fundamental factor in valuation and underwriting. And today it's interesting because we've kind of got some extreme situations where some rents have grown and are projected to grow in double digits for a year or two. And so that makes it for an interesting situation where you might be looking at a deal and looking at the in-place cap rate or underwriting just conventionally, and you might be thinking, wow, this is such a competitive deal, or it's overpriced. But if you fully appreciate the growth potential and the downside risk mitigation that comes with some of these powerhouse markets, you can get more comfortable with the value. Okay, number 5, coming in with exit strategy. I think I've kind of mentioned a lot of different exit strategies over the course, especially talking about debt. You've got the short-term exit strategies where you're going to want flexible prepayment penalty. And then you've got longer exit strategies, which are supported by cash flow focused investments, which I think are really great today. Today is a great opportunity to buy in-place cash flow and finance it with a low fixed rate loan, and you've locked in a great spread, and you've got certain 10-year cash flows. And everybody loves value add, and value add is how you get higher returns. But if you're talking about just a great basis play, a much lower risk, certain return, doing that, finding just a newer asset in a great location and doing that strategy is fabulous. So that's a longer term exit strategy. And so there's different ways you can go, but what you have to do as an underwriter is you don't, in my opinion, you don't approach the deal and tell the deal what exit strategy you should do or business plan. You should let the deal and the market tell you within reason, right? If you're a short-term hold person, then there's nothing, even if the deal screams, long-term hold, doesn't mean you should do it, right? You should stick to what your principles are and your strategy. But there should be some feedback coming from the deal side and telling you, okay, this deal is conducive to a longer term hold, and then you should, use appropriate debt to match that business plan, and then your exit strategy to match that. So everything is in alignment. And if everything is in alignment, that's likely going to allow you to actually bid most competitively for the property and hopefully win the deal, because that's what we're all here to do, is not be theoretical investors. We need to, buy deals. We need to be in them and do so while staying safe and avoiding downside risk. So that's a quick wrap up there on the exit strategy. Thank you so much for letting me fire off these 5 main points. Happy to answer any questions and dive into anything.
Thank you very much. That was a lot of information. It was fantastic. Did we catch all the questions from the chat, Mike? Or
Yeah, there's one just popped in. So I had put one about rent control in the high rate growth predictive markets. Any concerns there? And then we have another question about rent growth. Option 3 is ideal for VA, bump up the rent by 80 to 100 after reno, then grow the rent by 2 to 5 depending on the market.
Yeah. And I think, some of this, we're getting into the art over science, and, there's also a function of, you might, your numbers might say the same thing at the end of the day, but the presentation of the numbers is important. No matter who you are or how you slice it, it is important that you present the numbers in the way that is, most straightforward, most appealing to investors. If you have a convoluted business plan and, we're going to do a refi in year 2, and then we're going to add a supplemental, and then we're going to bump the rents here, and then rent growth and up and down, it's just a harder sell. So the simpler you can keep it, the better. And then in terms of rent control, I think there's positives and negatives with rent control. I mean, I think as a policy, it's negative, but in terms of underwriting, you can underwrite to a max. Especially if you have high conviction that you're in a strong market, and, let's say rent control, the policy in that area allows for 5% rent growth, you might be comfortable and willing to underwrite to 5% growth, just throughout the hold period. And the other, thing about rent control is it often mitigates new supply. So I think in those rent control markets, I'm certainly not an expert in rent control markets, but from what I've seen, you want to buy newer property, potentially Class A property, because you likely, unlike most parts of the country where there are few supply moats, if you are in a coastal market with rent control, for example, those are supply constrained, and new supply is difficult to make. So if you buy an A-class property, it's less likely that there's going to be a bunch of new A stuff coming right behind it, and causing negative rent growth to occur. Unlike a lot of our favorite markets out there, like in Austin, Texas, for example. Actually, Austin saw negative rent growth in the Class A space last year due to all this supply coming online and the pandemic, right? It hurt that higher end class of renter in terms of rent growth. Now, obviously, delinquencies and bad debt is most apparent in the lower class assets where tenants' incomes are less stable, and those tenants have less cushion through savings. So you've kind of got a rent growth, pick your poison. You can have negative rent growth, which many Class A markets throughout the country experience negative rent growth, or you could battle delinquency. So, fortunately for all of us that own workforce housing, the government stepped in a big way, and, really protected the security of a lot of these lower workforce housing tenants. And so, we were able to keep our occupancies high and actually able to collect and minimize delinquency, even if tenants were not able to pay. So kind of a tangent there, but let's see. I've got a question here on 2021 underwriting for bridge loans. Do we project interest rate increases with potential price declines 3 years from now? So that's a good question on the interest rates. So the way that we underwrite, so anytime we have a floating rate option on our underwriting, we're going to use what is called a forward curve to project out the path of the index rate that the floating rates are based on. So bridge loans today are primarily based on LIBOR. So we would input the LIBOR forward curve, which is just, like I said, a projection of where LIBOR will be over the next few years. And then we'll base our all-in borrowing costs accordingly. And then on the floating rate side, on the agency side, Freddie Mac is leading the way to the LIBOR to SOFR conversion. So SOFR is the index rate for Freddie Mac floating rate loans, which we are using and big fans of. So that's how we account for rising interest rates. So we absolutely are accounting for rising interest rates in line with market expectations. And then in terms of price declines, I do not, I can't really say that we're underwriting price declines. I mean, obviously, especially with a bridge loan, right? You're buying here with the plan to raise income and raise value to there. Now, it's up to, the individual, sponsor and investor to determine what the appropriate exit cap is, or exit cap in relation to the prevailing cap rates today, and, decide whether you want to be flat 25 basis points, 50 basis points, 1%, and determine whatever you need to feel comfortable. I think generally speaking today, just given how competitive the market is, you don't really have the luxury to underwrite, any material cap rate expansion. You can't say, oh, well, I'm going to sell this at a 7 cap 5 years down the road, because, you'll never be a competitive bidder at that point. So you got to pick your spots, and you have to be realistic while staying safe. So that's how I look at it.
Or is that all on the question?
Yes.
Okay, I've got a couple comments that I want to make. One of the things I just wanted to bring up on the bridge loans with the Capex line of credit, make sure that, as Rob said, make sure there's other funds available, because one, you never know how long the lender is going to take. But the other thing is to make sure that if other things come up where you're going to need some of this Capex, you better have a Capex available, because your lender may restrict you to what you put in there in the plan as what you're going to be doing with the Capex. But another thing is when you are putting your plan in for the lender on your Capex plan, be as generic and general as you can. The more specific you are, the greater chance that the lender is going to make you stick to that and say, hey, this is what you said you're going to do, so we're not going to give you your money back because this isn't on the list. So you want to be very general and not specific as much as possible, but make sure that you have sufficient funds available for the unknown, for the unexpected. And I don't have to tell you how I know that, but it is a difficult situation when you're trying to fund Capex and you're waiting for your lender to give you your money back, and only for those specific items that you said in your plan. Um, the other thing I wanted to mention is you were talking about insurance, and you went up to $1,000 a door. Well, I had a deal, a Houston deal, that we actually closed on the deal at 1,100 a door, and within 6 months we got it down on another bid down to 800 a door. But we originally in our budget had 500 a door, which we thought was generous. We thought that was a good rule of thumb, way above the rule of thumb. And then we ended up being 1,100 a door, but we were able to get it down. If it wasn't a fabulous deal to begin with, if we didn't underwrite it, we on our underwriting, that deal was about an 11 and a half cap when we bought it. And that $1,100 a door insurance brought it down to about a 9.5 cap purchase price. So if it wasn't a great deal to begin with, that $1,100 a door would have killed the deal. But make sure that you get insurance bids well ahead of the end of your due diligence, to make sure that if things don't come in the way that you need them to, you have the ability to back out. The other thing I wanted to ask, Rob, have you heard of coinsurance?
No.
Okay. Coinsurance, I've seen on several occasions. And basically, I've seen it typically with an 80%, 90%. I even saw 100% coinsurance. What coinsurance means is if you have your property, say you buy a property, it's valued at $1 million. And a couple years down the road, that property is now valued at say $1.2 million, $1.5 million, and you haven't upped your insurance, you haven't increased your insurance, you are now underinsured. So depending on how far you're underinsured, they will reduce any payout by that percentage that you're underinsured. So I tell people never, never, never get insurance with coinsurance. Otherwise, you need to make sure that you're covered for the value of that property. So, for instance, if I was, say, 50% underinsured and I had a $100,000 claim, even though I've got $1 million worth of insurance, I've got a $100,000 claim, they would only give me a percentage of that 100,000 based on your undervaluing of the property and you being underinsured. I'm kind of, you've never seen that one. I've seen it a few times, especially at the 80%, but I have seen it 90 and 100%. So you have to insure for 100% of your current value. Otherwise, they're going to penalize you.
So is that something you've built in the underwriting then?
No, the thing is that's something that when you get your insurance bid, you make sure that you get a bid without coinsurance. That would be something that if it says coinsurance in there, I always told my agent that no coinsurance. I don't want any coinsurance in there. And it may affect your premium a little bit. You may pay a little bit more, but I feel that one's one that's definitely worth making sure it's not in there. In fact, I've seen it where the lender will not allow coinsurance. Okay. There are a lot, I've had lenders have a statement in there. And typically what I'll do on the insurance is I will ask the lender for their insurance requirements. And I will pass the lender's insurance requirements on to my insurance agent, and they would find me insurance based on those requirements. And I have seen it several times that there is no coinsurance allowed.
Yeah, the cliche is lowest price is not always the best.
No, no, it's not. And I forgot what it was called, insurance where it's kind of a group insurance where they'll combine insurance. Do you recall what that's called? Are you know what
Master
I'm,
policy.
what's that?
Master policy.
Yeah. Where when we were in Houston, they wanted to do like a master policy where essentially there is a cap. So say an insurance company has, um, let's say $100 million worth of properties under their umbrella, but they would have a cap of say, I don't know, 50 million. Now, if you just had an individual problem on your property, there you're going to be well under the cap. There isn't going to be any problem. But if a storm comes through like what went through Houston, and say they've got $100 million worth of claims, but there's a $50 million cap, that means your claim is only going to be funded at a fraction of what the claim is. So you want to be real careful about those kind of things. Now, if the insurance company had properties all over the country where one catastrophic event is not going to affect uh, multiple properties in that group, then you may be okay. But if you've got somebody that's got a concentration in one area like Houston, and all of a sudden they've got $1 billion worth of failures or of damage, that could very easily go beyond that cap, and you only get a fraction. And the premiums are significantly lower. So as you're saying, lower isn't always better. So a master policy such as that, um, isn't typically the best. And again, that may even state that may state that in the lender's requirements that they may not allow that, or you may need to check if you were going to enter into something like that. But I certain wouldn't do that unless it was spread around the country as opposed to localized. Well, I don't know about you guys, but I think Rob did a fantastic job. Do we have any other questions? Anything in the queue, or anybody want to raise their hand and ask a question?
Yeah, I know there's folks in here, at least in the breakout rooms, that we're starting with smaller multifamily. And then a buddy of mine, Kunal, is on here. He's recently done a GP side of a 60 unit. So I'm just curious if anybody has any more underwriting questions for
Oh,
Rob.
Kathy has one. Where did you find an 11
cap?
No, as a matter of fact, this was in 2013 in Houston, where properties in Houston at that time, and don't fall over, because the properties were going, the C properties, working class property, were going for about 25 to 35 thousand a door, and the property we bought under 21,000 a door. And on my numbers, it was about an 11 cap. It was not on market, totally off market. It was on a cold call. My broker made a cold call on the property. We got a great price on it. And then 3 years later, we sold it on a 7 cap. So, and people are thinking, wow, 7 cap. Well, in 2016, the cap rate was probably about 6 3/4, and we sold it on a 7 cap. We weren't being greedy, because we made a killing on the deal. So yeah, now, the same properties down there, I don't know what they're going for, 5, 4 caps, whatever, but down in Houston, I don't know what down by Hobby Airport, Rob. You know what cap rates those are going for down there?
Yeah, it's I mean, for a 2013 vintage property, it's
No.
going.
The vintage was in the 60s. It was a 60s
Oh,
vintage. But the thing is,
understood.
I sold it in 2016.
Right. Okay. So for a Class C property like that in your hobby, um, I'd say 4.5 to 5 cap.
Yeah, we sold it for 7 in 2016, but we bought it at an 11 in 2013. So, but you don't you don't find those often.
Well, I always think about 2013 as being the best year in history to buy real estate, because things had started to actually improve economically, but pricing was still outrageous. And then debt was coming back. So what debt did you put on that property?
We had bridge debt. I think we might have been paying about 7% on the bridge. But we did have a prepayment penalty on it, though. Yeah, we had a prepayment penalty, and we sold it 2 years early, and it cost us $90,000 on the prepayment penalty. But considering that we sold it for 600,000 more than we had planned in year 5, and we did that in year 3, the 90,000 didn't bother us too much. So, it just depends.
I got a question for Rob, but I don't know if it's appropriate for the group right now or not. But you had posted a while back about preferred equity platform, and I wasn't sure if that was something you were going to talk about with the different debt structures tonight. I know we talked about interest only and getting competing with that versus some of the 1-year term interest only or fully amortized. Is that something that is still kind of investors could look to use as an advantage?
Yeah. So preferred equity is, I mean, it's certainly available at all points in the cycle. And for those that aren't familiar, preferred equity is a it's a financing product that straddles the line between debt and equity. It's it is legally equity, but then it's structured to be like debt, where it gets paid a fixed rate of return, and it sits directly on top of the senior loan. So the senior loan gets paid first, obviously, and then preferred equity is first in line to be paid after the senior loan, both on cash flow and on a sale or a refi. And if you're looking for added leverage, or if you're in a situation like, for example, you're assuming a loan and the leverage is low on the loan assumption, you can gross up your leverage with preferred equity to something more. So preferred equity is, there's a lot of players out there, and so the terms vary quite a bit. Our preferred equity currently, we're much more. 2020 we were focused on our preferred equity. We launched it in 2020 in response to COVID, because we saw that senior loans were coming down on their leverage and they were holding back the COVID reserve. And so that was leaving a big gap for us to come in and fund a few pref deals that we did last year. But 2021, we've flipped back the acquisition side on, and we've been focusing on that. So we've been looking at pref deals very selectively, looking at a deal in Dallas right now. But so our program goes up to 85% of cost. So if you had, let's say, for example, a 70% LTV agency loan, that might not be as much leverage as you are looking for, and so you can get up to 85% of cost, through preferred equity, and reduce your equity requirement that you have to, money that you have to go out and raise. And also, if your deal is good enough, you can actually magnify your returns through pref equity, because obviously you're getting more leverage. You're paying the pref provider a fixed rate of return. So assuming that your levered return is in excess of that return, then you get positive leverage. But preferred equity is expensive. And that's why, like I said, you have to have a deal that really justifies the pref, kind of just like a bridge loan, right? What you can look at, there's many ways to look at it, but one way to look at it would be a weighted average cost of capital, which would simply just take your senior loan and the interest rate, and then plus your pref equity and its interest rate, and then add those together, and then that's your blended interest rate across that combo of the cap stack. And that'll come out to a little bit more kind of like where a bridge loan is on the so it's similar to a bridge loan, but you're stacking it together through two different products, and you are likely have more flexibility on maturity, so you kind of have maybe less risk potentially than a bridge loan, just depending on how everything looks. But yeah, that's the quick take on pref.
And for anybody that's curious about more information on the capital stack, I do have a little white paper that I wrote. Just drop me a line and I'll be glad to send that out to you. What do we got? What is this? Crazy for the 60s. Oh, I think she was commenting on my pay GPs after LPs.
Yeah, and I think Kathy originally said she's looking in the co-GP BC class in the Texas Triangle or Huntsville, as well as new development.
Yeah, she said when the 4 cap, is there going to be any money for the GPs after? Yeah, probably. That all depends. Yeah, 4 caps are tough.
If I unmuted myself just to, my issue is I can't find a deal that pencils, because I may underwrite it and end up with a 6%